All right, picking up where we left off, our next inquiry is by Robert. Okay, his question is, Michael, when looking at the interest rate triad, if two make lower highs and one makes a higher high, would that indicate bearishness in the dollar index? All right, so let's go over to the charts real quick. All right, so what I got here is, this is investing.com, and I have the 30-year Treasury bond against the dollar index. Okay, this is the dollar index down here, and the bond market, 30-year Treasury. And I want you to see how they basically move with one another. And then as bonds were slowly drifting lower, but consolidation, we have that weakness on the dollar this year. Okay, so when bonds are being purchased, okay, so your go-to cheat, okay, little legend, if you will, in your mind. When they're buying bonds, when they're buying the futures contract, okay, or buying the treasury market, they got to have dollars to do so. Okay, so if there is a bullishness to bonds, generally that's going to allow or promote bullishness in the dollar index. Okay, if the dollar index is going lower, that's going to be supported if we see the bond market moving lower. Okay, the futures contract, because there's a lack of buying bonds. Doesn't mean you can't get a dollar bull market. It just means that it's much healthier to see a bull market when the bond market's going higher, when you see it in the dollar index as well. There are going to be times when the dollar index can rally, and it's not really attributed to buying bonds. That's the one caveat. Okay, that's one of the things I think is messing people up. Just know that the best scenario is this. Bullish bonds is great for bullish dollar. Bearish bonds is good for bearish dollar, but doesn't always mean so. Okay, so it's a little bit of a gray area in there. So let's take that a little bit further. If we go over to the bond market and we look at the 30-year against the 10-year and the 5-year, okay, you can see how when we are anticipating a bullishness on the bond market as a whole, we're going to see divergence between the three specific time frames, the 5-year, the 10-year, and the 30-year, respectively. Your question is, if two of them make a lower high and one makes a higher high, would that equate to a bearish dollar index? And the question is answered by simply knowing if we are in a condition where the market is predisposed to have the dollar go lower. That means if we've seen continued weakness in the bond market, okay, or a continued weakness in the dollar index. Then if we see the divergence at the highs, okay, you only need one really to diverge. So you're asking if two of them fail to make a higher high and one makes a higher high, is that bearish for the dollar? In the sense that if we have a weak dollar already, in other words, it's in a bearish market, and best scenario, if the bond market is in a bearish market as well, or consolidated, and then by looking at the 10-year, 5-year, and the 30-year in relationship to one another overlapped, okay, the way I did this chart, in case you were wondering, is I just clicked on the compare button right here, and I just added the symbols, and you can see the symbols over here respectively, right here. And by having that on the chart, you can look for divergence across all three. So now I'll give you an example here where it would be indicative of a bearish dollar. All right, so here we can see the divergence between all three. Here's your example or your question. If two fail to make a higher high, or they make lower highs, as we have here, and one makes a higher high, does that indicate bearishness on the dollar index? In this case, we are during a primary trend in the bond market, which is here. Okay, we're moving slightly sideways, but has a very small, modest downward move to it. Okay, and it's occurring rather at a time when we see the divergence here. lower high, and the higher high. Okay, so we have a triad divergence, and it's bearish in this sense because we have all three that should be in agreement with one another making higher highs. It doesn't do that, so there's a crack in the correlation. So this indicates at that moment, and we're going to say the around 4th July, again, when there should be a significant turning point in the marketplace. We're going to expect to see the dollar index the first week of July start to sell off. Okay, and we'll go back over to the dollar index. Here's that dollar index down here. You can see we have had weak prices since then. We have only recently just made that low, and we called that low based on a longer term.